Paul Morrow here, Smart Financial. Welcome back to the channel. If you haven't subscribed already, please do so. It's great, very helpful for the channel. We're trying to do as much financial education as we can. And I know that some of the topics that we talk about are advanced, but this is very basic. It has lots to do with knowing who you are and what your goals are. I'll tell you a real example from our practice the last 50 years, and this is a very typical scenario of a 30-year saver, one of our most successful clients of all time. She was very afraid of investing, very afraid of the stock market. She was actually a super technical person. I won't out her, but she was very instrumental a number of years ago in working in the companies that really gave birth to the internet. And, as far as the super brilliant nerd is concerned, she was like, in the dictionary under nerds, you could see her picture. And so we'll just call her Diane. And Diane came to me. We were old friends from college days, and she had her first great job, and she was ready to do some investing. Now, she wasn't like the kind of person that you read about that started, buying stocks like Warren Buffett at 12 years old. Okay, so she was already like, 30 something, let's say. And so she figured that she had maybe 30 years between her current age and what she kind of thought of as her retirement age. I mean, that's a good long haul, 30 years of saving. And she was a banker, and she was a very conservative person. She had money in like 4 different banks. Her idea of diversification was to have a CD in 5 different places at slightly different rates. And it was really cute. She's a great lady. She's a good friend of mine to this day. I'll tell you the conclusion of her story. But in the beginning, when we first met, I was a young advisor, and she was, obviously a client, and she didn't have a lot of money to invest, but it was about $10,000 a year that she thought out of her income that she could put aside for her future security. Now, I won't tell you about how great her income improved after that. She became a very successful person. She married a great guy. They became successful. But, she was a single person. She was young, 30 something, and she was responsible, and she wanted to have a pretty serious nest egg, but she had cash flow limits. So let's just talk about the parameters, and we'll talk about if you should be thinking of yourself as a saver or an investor. Now, there's no good or bad about this, and I will tell you, you should never invest in things that make you uncomfortable. A famous singer, Fats Waller, once said, if you don't understand it, don't mess with it. And that certainly applies to all kinds of exotic investments and, digital currency and a lot of that stuff. If you're not comfortable, or you can't work with somebody who makes you comfortable, then you shouldn't mess with it. You shouldn't invest in things you don't understand, right? But this is going to be very, again, basic. I don't mean to dumb it down, but I do think self-awareness in the money world is really important. Some people are very risk adverse. We have some members of my family that are very risk adverse. I'm married to a very conservative Canadian military child, and Linda is probably one of the most fiscally conservative people in the world, which is great if you have a spouse like that who really stretches the nickels out and watches every penny, and she's a great budgeter, right? But not everybody's built like that. So what is the difference between saving and investing? And let's be realistic. If you put money away in the bank today, a high yield savings account, there's an infinite number now of digital banks and other places that you can stick money. And I have to say that if you have a significant amount of savings, that you should have a target rate in savings of about 4%, FDIC insured, annually, compounded interest, and you can get that in a lot of good places. And I don't mind giving a plug to Capital One, Amex Savings, and Marcus, and all the good places that we work with over the years. In my practice, we have worked with some companies that are not so great, but of those few I just mentioned, by way of personal disclosure, I had money with all these folks. I think American Express has been great to our family. They have a great savings program. Capital One's been very helpful. And I think that also the Marcus people, which is Goldman Sachs, is a good, safe place to park money. But you can look this up on your own. You don't need my help. And a lot of the local banks are becoming very competitive, and they have high yield programs. And I'm not talking about locking up CDs for 10 years. I'm talking about today's current, high yield money market rate. So that's about 4%. Now let's talk about the other side of the world, okay? This is what we call the shallow end of the pool. This is where you're in the water, but you can touch, you know what I mean? So you're very secure, And for those people that are a little water adverse, you know the difference when I talk about being in the water, being able to feel the bottom. Okay, here it's the shallow end of the pool. You can feel the bottom. And like every pool, there's a shallow end here, and there's the deep end of the pool over here, where you can't touch the bottom, but basically it can be a much more exciting swim or a dive. This is the deep end of the pool. The deep end of the pool we will call investing in capital markets, you know, the S&P 500 and the Dow and all kinds of public markets. The lifetime rate of return on those types of investments as of today, looking backward over the last 20, 30 years, is about 9%. However, if you remember watching the great Spider-Man movies and the quotes from his uncle to Spider-Man, and I think it's been said many times that there is no great return without great risk. You know, with great power comes great responsibility. There is no great return without great risk. Now, I will help you quantify the risk, and you might decide that the risk is worth it to you. But again, just because you see a difference between 4% and 9%, you know, that might not be motivating enough to you when you understand at the deep end of the pool, you could go down. You could lose money, all right? Every investment has the possibility of loss, okay? Investments are not FDIC insured. Your principal is not guaranteed. And I know that we have worked over the years with many people who absolutely could not take this part of the transaction. They didn't have the internal fortitude, the tummy for it, right? The blood pressure for it, and that's fine. But here's the difference over time, and I'm going to explain that, you know, for the saver who's putting away $10,000 a year, it's never going to make you super wealthy. It will make you comfortable, and if you compound this interest over that period of time, you end up with a number, I have to look at my notes now, of exactly $560,000, which, as they say in the greater Boston area where I come from, that's not nothing, okay? It's something. It's $560,000, okay? And so if you got to 65 years old, you had $560,000, you would be better off than about 75% of the American population, okay? Only 25% of the Americans have over $500,000 in retirement savings. So you would be considered a comfortable success. However, if you took the risk to get to the deeper end of the pool and you actually felt like you understood the S&P 500, the Dow Jones, the NASDAQ, you know, and you were able to at least comfortably invest in those broad-based, I'm not talking about individual stocks now, those broad-based diversified investments known as mutual funds or ETFs, right? What would happen? The difference would be at retirement, there'd be about 1 million, here we go, 363,000, which is quite a bit more than 560,000, obviously. So why? Why do people do this instead of this? And why do they convert from being a saver to an investor? Well, with Diane, we had to do research. As I said, she was a nerd. She was very nerdy, and she wanted to know certain things like probabilities and expectations. So let me just say, there is no 20-year period in which you would lose money in the stock market. The potential of losing money in the stock market is dramatically increased the shorter amount of time that you're in. Let me say it again. The shorter amount of time you're in the market, you have a high probability of losing money. In fact, I'll give you an example. If you invest in the stock market for 1 year, you have a 50% probability of losing money. If you invest in the stock market for 5 years, you only have a 25% probability of losing money, right? However, if you invest in the stock market for 30 years, you have a virtually 0% chance of losing money. Now, anything is possible, but the longer you invest in the market, the greater the probability that you will get this rate of return. The expression that's used in the financial industry that time in the market is more important than timing the market. So for those of you that are thinking, well, are these real numbers? You can look them up. You don't need me. Since 1793, which is the first time they started tracking stock market investments, over 30 years, the stock market has averaged 9.33% average rate of return. Now, I wasn't around. Although I'm old, I was not around in 1793, but I was around in 1993 when we started investing with my young friend Diane. She ended up, by the way, and I got to give her a lot of credit, she ended up with a number larger than this just by investing on a monthly basis, not only her initial $800 a month, but every time she got raises, she put more and more in. And this is a young lady who never had one inkling, one desire to go out and speculate and buy the newest hot stock and all. She completely ignored the market. She kept her blinders on at work. She had a great career, but she retired with millions of dollars just by being a systematic investor. Now, in my book on wealth building, which you can get, you can go to Amazon and download either my Smart Financial Longevity, Smart Financial Grandparenting, or Smart Financial Wealth Building, right? There's more information about the basics of investing and getting away from just saving and becoming an investor to build wealth. I'm Paul Morrow, and understanding who you are, whether you're a saver or investor, is just part of the art of being smart.